pleasure of being joined by my fixed income project guardian friends, Alex Sulaimani from Euroclear, Andrew O'Neill, the head of digital asset analysis at S&P Global, as well as Lauren Schepens, who's the UBS head of Tokenized and digital assets for the APAC. As mentioned by the prior panel, over the last 6 months, we've all been working diligently and trying to provide guidance for the marketplace across these different asset classes. And for fixed income, we also just published the Guardian Fixed Income Framework. And in this, it's focused on providing an industry guide to implementing tokenization in debt capital markets. The framework integrates the ICMA Capital Market Association's bond data taxonomy and their capital markets and technology token standards, as well as the GFMA design principles for tokenized securities. So I highly recommend people looking to these documents, both what was done for the asset management as well as for the debt capital markets, because there are some really useful tools to help kind of build and scale going forward. Because as we all hear many times, principles, standards, guidelines is what everybody's searching for. So I'm going to turn to Laurence and Alex and kind of, give them the opportunity to, kick off and provide us kind of what are the generic benefits everyone is chasing.
Yeah, thank you very much, Allison, and thanks a lot for having us here. We have been in this journey for quite a while already. Very happy to see that Stephanie was just here, who showed our latest product launch on the asset management side. And within UBS, outside, I think there have been a lot of discussions, right? So we had a tool, and everybody was looking, can we use the tool? And I think what we have proven is, yes, the tool works, right? But what we're looking now for is what is it good for? And from our perspective, at least under UBS Tokenized, it's very much around access. So it's bringing access, lowering the burden, the operational, the technology burden, and providing access to different participants and different products on a broader scale. So that's really using the tool. Underlying, you have efficiency. So I think that's usually the number one. But I think that's also very challenging. I'm very curious to hear from Alex as well. When you have highly liquid, high volume markets and you bring something new, your incremental transaction cost is probably not going to be that much cheaper, right? And then the next step as well, other than efficiency as well as programmability, I think that's really a new tool. Where we also very much still in the early stages in figuring out how can we use it, how can we bring all the different benefits. But I think one which has been shown is, especially in the collateral space, if your asset is suddenly programmable, it's very interesting that you can start interacting on an asset level rather than going through institutions, which how collateral is managed today.
Yeah, thanks for the question. I think to complement what Laurence has said, everyone's after liquidity. That's been said numerous times, and what the new technologies allow us to do that today can be quite fragmented, even if there's players like Euroclear that are playing a role to centralize many of those things, is it also allows transparency. I think that's something that's not necessarily flagged as often as the obvious efficiency and some of the other access and these types of things. I think transparency, I think it's, in today's day and age when we can order something on Amazon and know where it is anywhere in the world within a few minutes, and when you don't have that same transparency for securities that can be worth hundreds of millions, billions, it's a bit strange. And so I think another thing that the technology brings, tokenization, but not only, is transparency, and I think this can bring additional add-on benefits like access and some of the other things we've already touched upon.
So recognizing those benefits, and as many of you know, there's been a lot of proof of concepts and use cases that have been demonstrated that the technology works. Laurence, coming back to you, what do you think is necessary to really kind of see full commercialization in this space?
Yeah, I think that's a bit the big question which everybody's asking. Is like, okay, we have the tool. It seems to work if you don't have rules. Quite a lot of innovation going out there. But how is it, to really scale, you need rules, right? And we have discussed so much standards, and I think that's the first thing. It's trying to apply the standards we already have. We don't need to reinvent everything, and bring them to the new technology is the first thing. Then if we start thinking about new interaction models, new characteristics for your products, you also need to think about new standards, right? And I think that's what needs to go in lockstep between industry participants foremost, right? Only when you do transactions, and I like the point which Kylin before made, is you have to do real transactions. We're beyond trying out the technology. You have to do real transactions because in my view, tokenization is always technology as well as legal frameworks. And only combined, you will start to learn where are gaps. So I think it's figuring out through that, where are these standards, and then we need to collaborate. We have to align on certain standards, and then we can compete on top of these standards, that's fine. And I think that's the first thing. The second thing, which I heard before already as well, it's having the cash leg as well as the asset leg on the same blockchain. Because really, just if you have it both on the same Excel sheet to make it very simplified, then it gets really interesting because then you can start overlaying formulas, etc. Then the life cycle kind of programmability comes into play. But I think the first challenge is figuring out how can I bring value just by taking the asset and putting it on the blockchain. And I think that's the hard one. We can do it, but finding a business case which already supports that. Because I think if you're going too complex, if you're going too fancy, it's so hard. You have to change so much because it's not just internal, it's also external. Because that's the point of the blockchain, is connecting, or that should be the tool, which the blockchain does very well, is connecting different participants and creating that trust on a technology layer rather than on an institutional one.
So Andrew, I'm going to come to you on this next question. What are the financial risk differences between, a private and public blockchain? That was raised on a couple panels ago and also on this last one.
Yeah, so I think it's a key question when it comes to kind of the next phase of this technology, particularly when we start thinking about interoperability, which was also discussed on the previous panel. But so we've rated quite a few digital bonds at S&P. Most of those have been on private blockchains on more of a proof of concept basis. That is great for kind of demonstrating the technology. It can support some transactions between clients of the same bank. It's not so great for building a market. So how does that then evolve? Do you have central players who control these networks? Well, then you're having quite a significant centralization of power. I think in the traditional system, we only really tolerate that level of centralization with CSDs. We wouldn't necessarily see that level of risk concentrated at a bank, for instance. So it's important to keep in mind that while we've seen these private blockchains develop, that they come with questions, they come with risks. We've also rated bonds, especially this year. We've rated the first issuances on public blockchains, on Ethereum and Polygon in particular. And so from our perspective there, the risk analysis is quite interesting and often, I think, misunderstood in a lot of the discourse on this topic. One of the key points is that not all public chains are created equal. Some have been around a long time, have demonstrated a certain degree of resilience, have a certain amount of perhaps economic security built into their consensus mechanism. But then also there are dependencies. Even though you have networks that are theoretically decentralized, there are still dependencies to be aware of. They're not the same dependencies that we're used to assessing in traditional markets, but for example, where are the concentrations of validators for a given network? What are the thresholds that you need to be worrying about? Do you need to be worrying about 51%, or is it 66? Is it even 33? In terms of the same entity controlling a set number of validators and potentially being a vulnerability either to attack or to error, and what that could lead to in terms of interruption of a network. So that's something that we're monitoring quite closely. I think something that we find quite exciting from a more kind of geeky analytical perspective is how you can monitor these risks in real time on-chain. You can see where the validators are. You can see what client software they're running. You can see where the cloud servers are that are actually being used to run certain validators. And so when events happen, such as the CrowdStrike event that happened a couple of months ago, and it leads you to reflect upon areas of centralization that exist in the existing world, beyond necessarily just the financial system, but and how that could operate in an environment where there's heavy reliance on blockchains, either for commerce or more specifically for financial markets. And that's where when you look at, for example, cloud servers that are running Ethereum or Solana nodes, you don't have those levels of concentration that perhaps some key businesses in the traditional world showed to have on that particular day. So I think coming back then to the rating analysis on bonds that are issued on these blockchains, a fundamental point for us is that the underlying credit risk is what drives ratings. The financial risk of a bond, whether it's a German sovereign bond or a Brazilian startup bond, those are different credit risks. And what platform they're issued on ultimately isn't the core driver. What we need to understand is what operational risk is being overlaid on top of that financial risk. There are operational risks in the existing system that we're used to looking at. Many people have perhaps forgotten about them because they're generally pretty standardized and people are comfortable with them. But as we see a new form of operational risk, it's understanding how that's mitigated, whether that's mitigated by an entity, whether that's mitigated at the level of a blockchain, whether it's mitigated at the token level that's created on a blockchain, so through token standards, for example, or indeed through the use of a protocol that builds in certain regulatory requirements or permissioning, for example.
You want to add to that?
Yeah, maybe I can put a bit the practitioner's point of view, because we have actually quite a lot of different networks coming in. Please come to us, issue on our network. We have so much more computing power, etc. And I always have to disappoint them, because I always have to say, actually, it's very boring how we choose it. And the first thing is, does it provide value for the underlying business case? And I talked about access. So our value is, if everybody can keep their own infrastructure and we can communicate through the same network, that has tremendous benefits. That's what we showed also as part of Project Guardian in Trident, where we issued a smart contract-based bond in Switzerland. We transacted that to DBS, and it got repoed through SBI. Everything on chain, money, asset, fully programmable, no off-chain transactions needed. Actually, the most painful part was, in the end, getting out of the stablecoin back into the traditional payment, because then it became manual, and we had suddenly days again instead of minutes. Everything else was transacted in days. For the traditional payment, the rest, everything was transacted within minutes across 3 jurisdictions. No integration needed. Everything was built within 3-4 months. So that's the benefit. So you're looking into an infrastructure where you already have the capabilities first. Second, security. So you have to rely it, and I think there is they have now shown they can be resilient, but you have to go really deep. And we're doing the monitoring, and that's the great thing. You have full transparency, you know what's going on. You have also full control on your assets, because we create a governance layer over our assets where we know exactly who's transacting, who has which rights. Everybody, even the investor, can check who can actually interact and has what rights with my asset. That's being made transparent on the blockchain, as well as in your product documentation. And I think that's really key, right? Especially from an investor protection perspective. So that's the 2 key criteria. If you don't fulfill these, not even going to consider it, right?
And Lawrence, are you using private or public blockchain?
So we use public Ethereum as well. We started actually private. It was a good first step to learn, but we figured then we very quickly came into the interoperability issues. So the next step for us was to go for public. But also there, we started in 2019 to start learning how we can set up these different governance rules, learning about the network, how it performs, getting comfortable with it. Transparency cuts both ways. On one side, fantastic. On the other side, you have to consider data privacy issues. So I think that's a lot of learnings, but that's why we are comfortable now to issue commercial products on Ethereum for a start with, which I think so far we had a good positive response. And then coming back to standards, that's also needed, right? It's on one side you need to monitor what's actually the governance process of your underlying blockchain, right? How is it actually governed? Who's influencing it? On top of that, the smart contracts, and that's for us the most crucial piece, because that's really where the value gets transacted in the end. The validator for me is should be as boring as possible, purely mathematical, and just validate transactions based on mathematical inputs. The underlying layer doesn't know what we're actually transacting, right? It's the smart contract where you have all the information, and then we're building the governance on top of that, right? And there it's now very much a lot of interesting discussions as well, is like, who should be able to manipulate that smart contract and how should that work? So there we're very happy that the CMTA also joined Project Guardian recently, because that's really just a governance layer with financial institutions, technologists, and lawyers as well. They're also important. And that we found that's a very good mix to create a standard on that level and also govern how the smart contract is going to develop going forward in lockstep with different regulations, different jurisdictions as well. So I think that's where really the crucial security and rule implementations will be happening. Just to add one point before I bore everybody, what I think is also very important on the smart contracts is, like, even if we find a way to either interlink different blockchains or we are on the same one ideally, the smart contracts also need to be aligned, because otherwise we are also a very big distributor, the largest wealth manager in the world. And if we find interesting products which are tokenized, we would by now need to do individual checks on a tech level to be certain that what we are offering to our clients is really has the right integrity, has the right rules. And I think we need standards and certifications, because otherwise this is not going to scale. It's going to be too much incremental effort to check each individual asset, which we don't do in the traditional side, because we have well-regulated institutions which have a lot of rules, making that sure nobody is asking where we're keeping our assets when they're at the CSD, right?
Yeah, and to that point, I mean, the future evolution of not just the asset class, but also of the ecosystem. And so what do you see the role of CSDs going forward when it's a fully commercialized digital asset marketplace?
Yeah, I mean, the role of a CSD, for those of you who are maybe not aware, you know, we are a trusted player, been around for, in our case, 60 plus years. We don't see necessarily the role of a CSD going away. We see it maybe enhanced, maybe evolved, certainly with new technology, with all the things that my co-panelists have talked about. So if you think about what a CSD does today, which is trusted intermediary sitting in between all the different players, at the moment at least, we may go full decentralized one day, full public permissionless, but for the moment, for the coming years, we believe that players like us can continue to do what we do. To, for example, if you think about in the tokenized world, who is managing maybe the smart contracts? Who is managing the cryptography keys? Who's managing the wallets? Yes, there's digital asset custodians, et cetera. Obviously, there's many players, and we feel that these evolutions are pushing us to do what we do today, to do what we do better. We also, in the previous panel, was brought up about regulation. You know, if you talk about, there's the technology, which no one will dispute anymore about the benefits of the technology, but in terms of legal settlement, in terms of understanding and making sure that regulation is conducive to allowing all this technological advances to happen, we're still not there yet. There's still quite a lot of evolution there, and I completely agree with Laurence that the standards, the official statements, and the work that GFMA, SIFMA, MAS, BIS, many players are playing is very, very crucial to help us get the market to evolve, and we're evolving alongside the rest of the market.
Maybe if I can add to that, which I also liked before, which was said, like, liquidity is still provided by having a central point, right? So somebody pulling in liquidity from different ways. Yes, we have seen different mechanisms going out, but in the end, even if you have a different, you know, bookmaking kind of or order making process, yep. For us, when we also did Trident, where we worked with 2 different financial institutions, in the end, we also had to ask ourselves, if you have a DVP contract or if you have an exchange contract, who should be in charge of that, right? Ideally, none of the trading partners, right? So I think there's more than enough room to grow. I think what is hard is sometimes to completely rethink how mechanisms could work, because then you go into the pain of aligning everybody. Nobody has a good, like you call up your lawyer and then you're the first one asking about that. That's usually very expensive. So I'm very happy that, you know, everything which is happening in the market brings us a bit further. And I hope we find some interesting ways how we can even bring more value than just tokenizing it and then really starting to get into services and taking advantage of being able to, you know, sometimes more directly interact with some of our peers.
And I mean, along those lines, it makes me think about, you know, 2025, a lot of people are thinking is going to be kind of an inflection point of like what happens, you know, is this really going to take off? We've had proofs of concepts, we have pilots, sandboxes, et cetera, around the world. But, you know, are we really going to see it scale? And what do you think are some of the key things that will help catalyze that and make sure it happens in 25?
Happy to go first. I think, you know, when we talk about technological adoption, often things disappoint in the short term and then over-deliver in the long term. I think so far in terms of tokenization, achieved the first part of disappointing in the short term in terms of scale. I think what the things that are really holding back scaled use cases at this point are really the interoperability and liquidity sides. So when we look at the digital bonds that we rate, we don't see those traded in the secondary market. So it's as we start seeing solutions emerge that enable enable either the trading on a secondary market on chain, or that enable in addition the on-chain payment leg, that really kind of moves the needle, certainly in my view, in terms of attractiveness to investors, because ultimately you need demand from investors for these things to scale. So the relevant developments to watch there, I think if we see, for example, the adoption of a US stablecoin bill in the near future, I think that will be supportive. In the EU, we've got the MiCA framework now that's in place, and we're starting to see the first kind of real non-US dollar stablecoins pick up in Europe as well. But as we see these things scale across different markets, I think that brings the tools. I think what's happening in the money market fund space is particularly interesting as well. That was discussed on the last panel. But you know, you may be aware there's something going on right now in the decentralized finance space through the Maker protocol, which is one of the more famous protocols in DeFi, where some of these tokenized money market funds are now coming into that protocol. So it's interesting to see these worlds coming together. One of these use cases will happen first to make it scale. Maybe it's one of the ones I just mentioned. Maybe it's corporate treasuries. Maybe it's retail. Yeah, I'm still cautious for 2025. Others may be more optimistic.
Yeah, I had my share of confidence crisis over the last 6 years, if this thing is ever going to take off. And I have to say, this year I've been the most confident. So far I'm okay with my career choices, or back again. I think we are now really at that inflection point where we go beyond the hype, right? And now building, right? And it's now beyond the headlines. It's about trying to prove the commercial value. And I think we have seen this year moving, right? We had a panel full of asset managers. I feel they made their mind up already, right? They have a clear plan. It seems to be commercially driven. So I'm very curious how that's going to pick up. And I have to agree, one of the most surprising things I've seen is the uptick of stable coins, right? It's not small value anymore. Also, if you look what's being transacted for payments alone, I think it is impressive. So something is brewing and ticking up. And what are the catalysts? Well, having a reliable money leg on chain is going to help a lot for bringing these life cycle efficiencies afterwards. Standards, where I also see a lot of positive development, also the industry coming together. I mean, on the Project Guardian, there's so many different initiatives which really bringing everybody together. And so, yeah, it starts, I think, first proving the business value. If somebody is going to run away with a good case, then everybody is going to follow very quickly, I'm sure. The second one is money, and the third one is standards, regulations globally, because we have global technology, but we don't have global standards. So hopefully we can also break through that.
Yeah, just to complement him, you touched upon it, this kind of regulatory arbitrage. You've seen recently the statements from the HKMA and what they're doing, for example, to foster more fixed income issuance. Things like this are going to continue. There's kind of healthy competition in this region between Hong Kong and Singapore, but more broadly, I think a lot of players want to do more, but if you talk about some of the values and the sizes of the transactions that you think about with Euroclear, for example, it's in the hundreds of millions, billions. So, you know, proving the value of the technology is one thing, commercialization, absolutely, but we also need to have regulatory clarity. If you're in a courtroom and you're across the stand from somebody talking about certain terms, you need to be speaking the same language, both legally as well as technologically. So I think regulatory arbitrage, whatever you want to call it, is one thing. And I also think that, you know, we've been talking about fixed income, asset management, alts, etc. I think there's other things that have gone, there's efforts, it's not nowhere, but there's things that have gone a little bit underdeveloped, I think. For example, if you look at loans, so our use case in the fixed income guardian work was around loans, just starting together with partners MarketNode and the Asia Pacific Loan Market Association. We believe strongly that particularly in this part of the world, where loans is still very prevalent versus debt issuance, if you compare it to other regions, why aren't we looking at loans and the technology that can be used there in a market that is today still T plus 30 plus, particularly when there's going to be so much financing need. If you think about ESG and climate change. So I think, you know, they all kind of converge. It's regulation, but it's also market forces, ESG, climate change, the need for sustainable financing. I think these things are going to push forward a couple of winners when it comes to commercialization. But I don't want to make predictions, particularly today. I don't think today's a good day for predictions. So.
Oh, but that was my lead up to the bit. You know, kind of what projections do we see across different asset classes? Obviously, we're in the fixed income group here, but kind of across the board. And then, you know, I can't help but think, as the Global Financial Markets Association, you know, that, you know, the differences we're seeing across Asia, Europe, UK, US, and then South America, which is also a key, you know, innovator. So I'll throw that out there. And if you want to differentiate by jurisdiction or just kind of like by only asset class.
Yeah, I think it's very hard. I would say the pickup, my view is the pickup is where you today have the biggest transaction costs and where there's lack of infrastructure, because that's the easiest way where you can get the, you know, bring in new infrastructure without reinventing an old one, which is very hard. And B, you have immediately a nice arbitrage which you can tackle. So that's my first thing. And then it's very hard to put numbers on it, but I think if we take the total securitized market, etc., if we reach 1% by 2030, then I think that would already be a significant goal, right? And then we're already in the $1 trillion space. So I think that would already bring, at least for certain sub-segments, it will be much higher. Right? I could imagine that 2030 some sub-segments are above 50% already. So yeah, very interested how this is going to pan out over the next few years.
Maybe to pick up on the sub-segments, I think one of the key benefits is going to be in terms of collateral mobility and what can be done with collateral. So those subsectors of the bond market and the fund market in particular, where the assets are frequently used as collateral, intraday collateral, I think they'll probably see the largest pickup. So that's going to be sovereign bonds primarily. It's going to be money market funds. And indeed, those are the use cases we're seeing tokenized now. But I think when we start seeing the US T-bill market go on chain, that's, you know, when that happens, it will happen quickly.
You're not going to project?
Well, again, I prefer not to predict today, but no, I think I've already mentioned. I think that there are going to be opportunities that are continuing what's already been done, but now we will have the standards that we didn't have before. We will have the regulatory arbitrage, which will be a force and can maybe help certain jurisdictions leapfrog. So I wouldn't predict, but I think this part of the world for me being based here now for the past 15, 16 months, I see clearly that between Singapore, Hong Kong, and the surrounding area, China, et cetera, I think this is probably, I'll do that. I'll predict that this part of the world will continue to remain central to all of that.
Okay, well,
Easy
thank you
prediction.
all. And I also want to give a big shout out. A lot of work's gone into the fixed income framework. This is version 1, and in 25, I look forward to working with you all again in developing version 2 as the markets continue to evolve.
Thanks a lot.
Thank you.
Thank you.